For many buyers in Malaysia, the most stressful part of buying a house is not choosing the unit. The stressful part is waiting for the bank to say approve or rejected. Banks are not guessing. They use a few clear tools to decide. Can you pay? Will you pay? What happens if you do not pay? In this video, I will explain how home loan approval in Malaysia usually works using three main pieces. Number one, your income and debt service ratio, or DSR. Number two, your credit reports, CCRIS and CTOS. Number three, your overall profile and the property you want to buy. By the end of this video, you should be able to look at your own numbers and have a clearer idea whether you are loan ready before you even apply. I am Hadi. I speak to many first-time buyers, including people working in Singapore who plan to buy in Johor. Very often, they are not sure whether the bank will approve their loan, and they do not know what to fix before they apply. This video is not about any specific bank. It is a general explanation on how banks in Malaysia normally think about home loans. We start with the first part, DSR. In simple terms, DSR is the percentage of your income that goes to paying debts every month. The idea is DSR equivalent to total monthly debt commitments divided by monthly income that the bank accepts multiplied by 100%. Total monthly debt commitments include things like existing housing loans, personal loans, car loans, the minimum payment for credit cards or a percentage of the outstanding balance, PTPTN and similar installments, and the new home loan installment that you are applying for. Monthly income depends on your situation. For salaried workers, banks usually look at basic salary and in some cases, a stable pattern of allowances or overtime. For self-employed or variable income, banks often use an average over a period and may apply a discount for safety. Different banks have different internal DSR limits. Some look at gross income, some at net income. But the concept is still the same. They want to see that after all debts, you still have a reasonable amount left for daily living. Here is a simple example. If the income accepted by the bank is 5,000 a month, and after adding the new home loan, your total commitment become 2,500, then your DSR is 50%. If another person with the same accepted income has total commitment of 3,800, after adding the new loan, the DSR is 76%. If a bank is only comfortable up to certain range, the first profile is easier to approve than the second. You do not need to memorize each bank exact number. What matters is understanding what move your DSR. Higher income, reduce your DSR. Higher commitment, increase your DSR. A larger loan amount or shorter tenure, increase the installment, hence increase the DSR. A smaller loan amount or longer tenure lowers the installment, hence reduce the DSR. Because of this, before applying for a home loan, it is helpful to reduce or clear small personal loans where possible, avoid new vehicle loans right before a home loan application, keep credit card balance under control, not constantly near the limit. If DSR is already very tight, even a strong payslip can struggle to pass certain banks. The second part is your credit history, shown through CCRIS and CTOS. CCRIS is a system under Bank Negara Malaysia. CTOS is a private credit reporting agency. Together, this report show what loans and credit cards you have, how much you owe, whether you pay on time, whether there are any legal actions and serious remarks recorded. Banks use this report to answer a different question. The SR answer, can you pay if we approve this loan? CCRIS and CTOS answer, do you usually pay on time when someone lends you money? In this report, banks typically look at any late payments on existing loans or credit cards. How many months this payment were late? How recent those late payments are? how high your credit card utilization is relative to the limit, how many active facilities you are managing at the same time. A clean pattern over the last 12 months gives more confidence. Repeated late payments in the recent months reduce confidence. One old mistake several years ago is different from a series of late payments that happened this year. Before you apply for a home loan, it is sensible to make sure all existing loans are paid on time every month. Reduce outstanding credit card balance instead of just paying the minimum, and avoid applying for many new loans and cards in a short period. In summary, DSR measures whether you can pay. CCRIS and CTOS show whether you normally do pay. Banks look at both. The third part is your overall profile and the property you are buying. Even if your DSR is acceptable and your credit reports are reasonable, banks still consider your income type and stability, your age and the loan tenure, how many properties you already own, the type and location of the property offered as security. For the income, fixed salary with EPF contribution and a stable employment record usually appears more straightforward. Income that is heavily commission-based or irregular may still be used, but banks often average it out and use a more conservative figure. Self-employed applicants usually need more documents and a longer, consistent track record. About age and tenure, banks limit the maximum tenure based on their internal policies and your age. A shorter possible tenure means a higher monthly installment for the same loan amount, which will push your DSR higher. And on number of properties, for first and sometimes second residential properties, buyers can often obtain a higher margin of finance. For later properties, some banks become more conservative, which means you may need a larger down payment. On the property itself, pure residential properties can be treated differently from commercial title units or hybrid products like Soho and service apartment. Age, condition, and location of the property matter because the bank is also assessing the quality of the asset they are financing. For certain property types or in certain locations, bank may be more careful with valuation or with the loan amount they are willing to offer. The key point here is that a bank is not only looking at you as a borrower, it is also looking at the property as security. Here is a simple way to prepare yourself before applying for a home loan. First, check your DSR roughly. List your current monthly commitments and test different loan amounts and tenure using a basic home calculator. Aim for a level where, after including the new installment, you still have comfortable space for living expenses and saving. Second, clean up your credit card behaviour for at least 6 to 12 months before application. Pay every loan on time, bring down credit card balance where possible, and avoid taking new short-term loans unless truly necessary. Third, stabilize your income pattern as much as you can. Understand that large change in income structure or frequent job change can affect how banks view your profile, especially for your first home. Fourth, match the property to your current profile. Choose a property type and price range that fits your actual numbers now, not just a best case scenario in the future. If you are looking at projects in Johor while planning your loan, I have prepared a free Johor project cheat sheet. It lines up selected Johor project with price per square foot and key details side by side, so you can quickly see which project sit within a realistic range for your income and DSR, and which one are likely to stretch your loan and cash flow. You can download it using the link in the description or in the pinned comment. Use that cheat sheet together with what you learned in this video before you decide which project to shortlist and which one to let go. See you in the next video.